You know the math I'm talking about. Not the math they teach you in school, not algebra, not calculus. I'm talking about the math you run in your head at the grocery store. The math where you're standing in the cereal aisle, and you're quietly calculating whether you can afford the name brand box and still make rent on Friday. That math, the kind that never turns off. This is what life below the threshold looks like. Your phone buzzes at 2 a.m. Not because someone texted you, because your bank sent you a low balance alert, and now you're lying in the dark doing arithmetic instead of sleeping. You're running through every transaction from the past week. The gas, the copay you didn't budget for, the birthday dinner you said yes to because you didn't want to explain why you couldn't go. You're piecing it together like a crime scene, trying to figure out where it went wrong again. And here's what nobody says out loud. It's not just the money that exhausts you. It's the mental load. It is the constant, grinding, relentless awareness that one unexpected thing, one car repair, one medical bill, one missed shift, and the whole system collapses. You're not living with a budget. You're living with a detonator. You start making decisions you're not proud of. You leave the dentist appointment unscheduled because you can't think about that right now. You let the car make that noise for another 3 months because the alternative is worse. You smile and say, "I'm good," when people ask, because the real answer is too complicated and too exhausting to explain. The worst part? You're working. You are not lazy. You show up. You put in the hours. And still, every month, it feels like you're running on a treadmill that's always slightly faster than your legs. This isn't a character flaw. This is what life below the financial threshold does to a person. This isn't living. This is surviving. If you're new here, this channel is called Begin Success, and we talk about the financial moves that actually change your life, not the ones that just sound good. Hit subscribe so you don't miss what's coming next. So what is the threshold? Not $1 million. Not financial independence. Not some number so far away it feels like a different lifetime. The number I'm talking about, the number that actually changes the game, is $50,000. I know what you're thinking. That still sounds like a lot. And if you're running that 2 a.m. math right now, it might feel almost insulting to hear someone say, "Just save $50,000, like it's simple. I'm not saying it's easy. I'm saying it's the number. And there's a very specific reason why. Here's what $50,000 actually does. First, it ends the cascade. The reason financial emergencies feel catastrophic when you're broke isn't just because they cost money. It's because one problem triggers 5 more. The car breaks down, so you miss work, so the check is short, so rent is late. So now there's a fee, so now you're borrowing to cover the fee. $50,000 sitting in an account doesn't just pay for the car repair. It stops the chain reaction completely. The emergency stays an emergency. It doesn't become a crisis. Second, it gives you time. Not time in the abstract. Real, measurable time. $50,000, managed conservatively, buys the average person somewhere between 12 and 18 months of living expenses. That means if your job disappears tomorrow, if your industry shifts, if your company downsizes, if your boss makes your life unbearable, you don't have to panic. You don't have to take the first offer that comes. You have time to think. And in the financial world, time to think is one of the most underrated advantages a person can have. Third, it changes who has power over you. This is the one most people don't talk about. When you have nothing saved, every person in your life with the ability to affect your income holds leverage over you. Your landlord, your employer, your lender. They know, consciously or not, that you cannot afford to walk away. $50,000 changes that equation. Not completely, but enough. Enough that you can negotiate. Enough that you can say no. Enough that the threat of disruption stops being a weapon someone can use against you. $50,000 is not a destination. It is not retirement. It is not wealth. It is the first line of defense. It is the point where you stop being financially vulnerable and start being financially dangerous. And that distinction, that specific shift, is exactly why certain institutions would prefer you never get there. Here's the part nobody puts in the brochure. Banks are not rooting for you to save $50,000. Not because they're evil, because you being broke is extraordinarily profitable for them. And I want to walk you through exactly how that works, mechanism by mechanism, so you understand what you're actually up against. Overdraft fees. When your account hits zero and a transaction still processes, your bank charges you for the privilege of being broke. The average overdraft fee in the United States sits at $35 per transaction. That doesn't sound catastrophic until you realize the Consumer Financial Protection Bureau reported that American banks collected over $7.7 billion in overdraft and non-sufficient funds fees in a single year. That money came almost entirely from the people who could least afford to pay it. The people below the threshold. High-interest credit products. When you have no savings buffer, you don't borrow because you're irresponsible. You borrow because the transmission failed and you still have to get to work Monday. Banks know this, which is why the credit products marketed most aggressively to people with low savings balances carry average interest rates between 24% and 29%. You needed $800. 2 years later, you've paid back $1,400. The math was never in your favor, and it was designed that way. Minimum balance fees. Many standard checking accounts charge a monthly maintenance fee if your balance drops below a set threshold, typically somewhere between $500 and $1,500, depending on the institution. Think about the architecture of that for a moment. The people most likely to fall below the minimum are the people who can least afford an additional monthly charge. The fee punishes the balance problem while making the balance problem worse. Predatory adjacent products. Payday lenders, rent-to-own schemes, buy now pay later traps with deferred interest. These products don't flourish in wealthy neighborhoods. They are geographically and algorithmically targeted at people below the savings threshold because financial desperation is a market. When you have no cushion, the cost of a bad decision compounds in a way it simply doesn't for someone with $50,000 in reserve. But here's the part that's really interesting. Every single one of these revenue streams, the fees, the interest, the penalties, the desperation products, they all share one thing in common. They only work on you when you have nothing saved. The moment you cross $50,000, you stop being a revenue source. You become something else entirely. Something the industry has a very specific name for. And we'll get to that next. So what do banks call someone who pays their credit card balance in full every month? A deadbeat. That is the actual industry term, not a metaphor, not an exaggeration. Inside credit card company operations, a customer who carries no balance, pays no interest, and triggers no fees is formally referred to as a deadbeat. Because from the institution's perspective, you are using their product and giving them nothing in return. You are, by their definition, a losing customer. Let that settle for a second. The behavior that every financial advisor tells you to practice, pay your balance, avoid interest, stay out of debt, is the exact behavior that makes you worthless to the institutions offering the product. You followed the rules. You did it right. And the system categorizes you as a problem. This is what crossing the $50,000 threshold does to your relationship with financial institutions. It transforms you from a profit center into a liability. Here is what that actually looks like in practice. When you have $50,000 saved, you don't need the overdraft protection they want to sell you. You don't need the emergency personal loan at 26% interest. You don't qualify for, or need, the predatory credit products that generate billions in annual revenue. You have a cushion, which means every product designed to monetize your desperation becomes irrelevant to you. But it goes further than that. A person with $50,000 in savings starts shopping for yield. They compare high-yield savings accounts. They ask about money market rates. They look at CD terms. Suddenly, the bank isn't extracting money from you. You are extracting money from them. The relationship has completely inverted. You walked in as a customer they could profit from and walked out as a customer they have to compete for. And institutions do not like competing for customers they used to own. There is a reason premium banking products, the ones with no fees, dedicated advisors, better rates, actual customer service, are reserved for people above specific asset thresholds. It is not a reward for good behavior. It is a containment strategy. Banks know that once you accumulate enough, you have options. So they build loyalty programs, private banking tiers, and relationship managers specifically to keep you inside their ecosystem once you become too expensive to lose. Below $50,000, they profit from your desperation. Above it, they compete for your loyalty. Same institution. Two completely different relationships. The only thing that changed was the number in your account. Make them compete. Here's something that doesn't show up on any balance sheet. When you cross $50,000 in savings, your brain physically changes how it processes decisions. Not metaphorically, neurologically. Researchers studying financial stress have found that scarcity, the state of having less than you need, doesn't just feel bad. It actively commandeers your cognitive bandwidth. It pulls mental resources away from long-term thinking and redirects them entirely toward immediate survival. Your brain, under financial scarcity, is running a different operating system than the brain of someone with a cushion. Psychologists call this the scarcity mindset. And it is not a character flaw. It is a cognitive response to a resource threat. This is what scarcity brain looks like in practice. You get an email from your employer on a Tuesday afternoon. Subject line, quick meeting. Request. Your stomach drops. You spend the next 4 hours catastrophizing, running through every worst-case scenario, replaying every conversation from the past month, calculating how many weeks of rent you have left if the worst happens. You cannot focus. You cannot produce. You are mentally paralyzed by a forward subject line. Now run that exact same scenario with $50,000 in savings. Same email, same subject line, but the cognitive response is completely different. Your first thought isn't survival arithmetic. Your first thought is, okay, what do they need? You walk into that meeting with your shoulders back and your mind clear because you already know, at a level below conscious thought, that whatever happens in that room cannot destroy you. The money in your account is not just financial security. It is psychological armor. This is abundance brain. And the shift between the two is not gradual. It is a threshold effect. It happens at a number. And the downstream consequences of that shift are enormous. Abundance brain negotiates better because you can afford to walk away and the other party can sense it. Abundance brain makes better career decisions because you're choosing opportunity instead of choosing safety. Abundance brain takes calculated risks because a loss is no longer catastrophic, it's recoverable. Scarcity brain, by contrast, accepts bad deals. It tolerates bad bosses. It stays in bad situations because the cost of disruption feels unsurvivable. It makes decisions from fear rather than from strategy. The cruelest part of financial scarcity is that it makes accumulating money harder precisely when you need it most. Because the brain running on empty is not the brain that builds wealth. $50,000 doesn't just change your account balance. It changes the brain making every decision that comes after it. When you're broke, everyone has leverage over you. Your landlord knows you can't afford to move. Your employer knows you can't afford to quit. Your lender knows you can't afford to wait. Every negotiation you enter from a position of financial scarcity is a negotiation you've already half lost before you open your mouth. Because the other party knows, consciously or not, that you need this more than they do. When you have $50,000 saved, that dynamic reverses. Across every major negotiation in your life, your job, right now, if your manager cuts your hours, passes you over for a promotion you earned, or makes your daily environment quietly unbearable, what are your options? For most people, below the threshold, the honest answer is tolerate it. Because the alternative is a gap in income. They cannot survive. $50,000 changes that calculation entirely. It means you can give notice professionally and spend 3 months finding the right opportunity instead of the nearest one. It means you negotiate your salary from a position of genuine willingness to walk. Recruiters and hiring managers can feel the difference between a candidate who needs the job and a candidate who wants it. One of those candidates gets a better offer. Your housing. Landlords hold enormous power over tenants who have nothing saved. They know a tenant with no cushion cannot absorb the disruption of moving, the deposits, the truck rental, the overlap, and rent. So they raise rates incrementally, defer maintenance, and push boundaries knowing the cost of resistance is too high. $50,000 means you can cover a new deposit, absorb a moving month, and walk away from a bad rental situation without financial catastrophe. That knowledge alone changes how you carry yourself in every conversation with a landlord. Your car. A person with no savings buys a car in crisis mode. The transmission failed. You need transportation by Monday, and the dealership knows it. You will take the financing they offer because you have no time and no alternative. A person with $50,000 saves shops on their own timeline, makes a meaningful down payment, and walks away from any deal that doesn't make sense. The desperation premium, the extra cost you pay simply for needing something urgently, disappears entirely. Your salary negotiations. The single most powerful thing you can say in a compensation conversation is nothing. A comfortable silence after an offer lands. Most people below the threshold cannot hold that silence because they need the answer to be yes. $50,000 lets you wait. And in negotiation, the person who can wait almost always wins. When you have $50,000, you stop asking for permission. You start setting terms. So how do you actually get there? Not theoretically. Not spend less and save more. That is not a plan. That is a suggestion. I mean a specific, sequential, executable protocol for reaching $50,000. Here are the 5 steps. In order. No shortcuts. No excuses removed from the equation. Step 1. Establish the account before you establish the habit. Open a high-yield savings account today. Not this week. Today. Separate from your checking account. Separate from any account tied to a debit card. The friction of accessing it is a feature, not a flaw. The national average savings account rate sits around 0.5%. High-yield alternatives are currently offering between 4% and 5% annually. On a $10,000 balance, that difference is roughly $450 per year. On the way to $50,000, that gap compounds into real money. The account comes first because saving into a checking account is not saving. It's waiting to spend. Step 2. Calculate your real monthly number. Take your monthly take-home income. Subtract your fixed non-negotiable expenses, rent, utilities, insurance, minimum debt payments. What remains is your allocatable income. Your savings target is 20% of that number, automatically transferred on payday. Not what's left over. At the end of the month. What comes out first? Saving what remains after spending is how people intend to save for years and never do. Saving before spending is how people actually reach $50,000. Step 3. Run the timeline math and make it visible. Saving $500 per month reaches $50,000 in 8 years and 4 months. Saving $800 per month gets you there in 5 years and 2 months. Saving $1,200 per month puts you across the threshold in just under 3 years and 6 months. Write your specific number on something you see daily. The goal needs a timeline or it remains abstract. Abstract goals do not survive contact with a bad month. Step 4. Eliminate the single largest spending leak first. Not all of them. 1. Research on savings behavior consistently shows that attacking multiple spending categories simultaneously leads to abandonment within 60 days. Identify the one category where money disappears without a proportional return: subscriptions, dining, impulse retail, and redirect that single stream toward the account. One surgical cut, sustained, outperforms a broad lifestyle overhaul every time. Step 5. Protect the account with one rule. The account has one purpose: emergencies only, not opportunities, not sales, not loans to yourself you'll pay back later. Emergencies only. Every withdrawal that isn't a genuine crisis resets the psychological progress alongside the financial progress. The discipline of the rule is inseparable from the power of the number. $50,000 is not a miracle. It is arithmetic, applied consistently, protected deliberately. Here is the simplest way I can put everything we've covered today. Below $50,000, you are playing defense. Above it, you are playing offense. And those are not just different financial positions. They are completely different games with completely different rules. Defense looks like this. You wake up every morning, and your first financial move is to protect what little you have. You make decisions based on what you can absorb, not what you actually want. You take the job because you need it. You stay in the apartment because moving is too expensive. You accept the rate because negotiating feels dangerous. Every financial decision is a reaction. You are not building anything. You are containing damage. Offense looks like this. You wake up and your first financial move is to identify where to deploy what you have. You make decisions based on opportunity, not survival. You leave the job because a better one exists. You negotiate the apartment because you can afford to walk. You reject the rate because you have time to find a better one. Every financial decision is intentional. You are not reacting to the game. You are running it. The institutions that profit from your financial vulnerability understand this distinction better than most people ever will. They have entire business models, product lines, and marketing departments built around keeping you on the defensive. Overdraft fees keep you reactive. High-interest products keep you dependent. Minimum balance penalties keep you penalized for the very problem they're exploiting. The system is not broken. It is working exactly as designed for them. But here is what the system cannot survive: a person who decides to cross the threshold and refuses to stop until they get there. Because the moment you hit $50,000, the fees stop. The desperation products become irrelevant. The leverage they held over every negotiation in your life dissolves. Your brain shifts from scarcity to abundance. Your decisions shift from reaction to strategy. And you become, by the industry's own definition, a deadbeat, a customer they can no longer profit from, a person they now have to compete for instead of exploit. That is not a coincidence. That is the whole point. So let me leave you with this. Every dollar you move into that high-yield savings account is a dollar that is no longer working for them. It is working for you. Every month you protect that account, you are 1 month closer to a version of your life where nobody holds financial leverage over you. Get to $50,000. Make them hate you.